Welcome to Primary Markets TV, Europe, Middle East and Africa, your update on newly issued securities. I'm Dan Barnes. Europe is far quieter than Asia Pacific for IPOs this week. On the LSE this month, we're expecting to see the listing of diagnostics firm Abingdon Health, date as yet unconfirmed, and that will be on the AIM market. And AIM also saw the listing of Helium One Global the week before last at a price of £4.50 a share. Continue to see a lot of bond issuance reported to the LSE, many with sub 1% yields, with 20-year bonds from Nestle and BP Capital Markets recently. In the rate space also, UK MPs have challenged the pricing of UK government bonds being issued to market, suggesting that investors might have paid more than the price set by syndication banks recently. The FT has the story, notes the deals going into the market have been snapped up at the highest price point, indicative of deep investor appetite. MPs have requested a response from the Debt Management Office. Euronext saw the IPO of video-on-demand firm Alchemy the week before last on the Euronext growth market at a price of €16.20. And last week on the Oslo Bourse, which is also part of Euronext, it saw Meltwater issue. That's a provider of media intelligence and social analytics software as a service. That was admitted to trading via the Euronext growth platform on Oslo Bourse. In Spain, the BME welcomed ASPI to its growth market on Friday, the ninth company to list on BME Growth this year. It also issued a €650 million bond to trading from Six Group with a 0% coupon and a yield to maturity of 0.009%, with maturity in December 2025. The issue was 4.2 times oversubscribed. Six Group, of course, actually bought the BME for $2.8 billion this year. I'm joined now by Dr. Sebastian Raedler, Head of European Equity Strategy, Bank of America Merrill Lynch, and Barnaby Martin, European Head of Credit Strategy at Bank of America Merrill Lynch. Guys, welcome to the show.
Thank you.
Hello.
Sebastian, if I can start with you, there's been a lot of hope for a recovery from the COVID-19 shock, which has already been priced into the equity market after a strong rally since March. What does this mean for equity investors?
Well, the key question that investors now have to ask themselves after a 40% rally from the lows in March, is there any value left? The clients we spoke to at the beginning of the year, they were very worried about the outlook, and there were many reasons not to engage with the rally. People were telling us in April and May, unemployment is going to rise, defaults are coming in Barnaby's space, uncertainty is very high, and yet the market has done what it always does. The big trap that people typically fall into is they don't look at the rate of change, they look at the level. That means at the bottom of the market, when growth is very weak, they're very concerned. And then at the top of the market, when growth is very strong, they're very bullish. What has happened is growth has accelerated very strongly. The market has risen. And we now have the ironic situation where the rally has continued, even because in Europe, because of the lockdowns, the second wave of the virus, growth momentum has slowed. And the market has simply said, I don't care, because I know this is temporary. I know the vaccine is coming. And so the best way that we have to quantify it and to answer the key question, is there some value left, is to ask, what is the growth scenario that is now priced into the market? How much acceleration is in the price? And how does that compare to the acceleration that is actually coming? The best indicator for the equity market is called the PMI. It's a measure of business confidence. It has fallen from a peak of 53 to 44. The market is priced for it to go to 54. But given the large amount of spare capacity you've got in the economy that likely will be reactivated next year, we think the PMI will go to 60. That means a lot of good news is in the price, but there's more to come. We have just turned neutral on the market after a 40% rally, simply because the market has overshot. It has looked through the near-term growth weakness. We see no further upside until around March. But if we're right that by the middle of the year, you will have a very strong growth environment, there's another 10% upside or so to 440 on the stock 600. And we are saying this upside is unlikely to materialize in the near term. But if there's any pullback, or if finally we get to the point and the market doesn't move very much, then from the end of the first quarter onwards, we've got another 10% upside before the cycle peaks by the middle of the year.
That's very interesting. What are the implications of that for individual sectors?
Well, there you've got pretty much a bifurcation, especially among the cyclical sectors. On the one hand, you've got the ones where a lot of the good news is already in the price. Autos up 40%, capital goods up more than 20%. So we were overweight early in the year. We've just neutralized it. And what we're telling clients now, focus on the sectors that have very little of the good news priced in, but that they have the same macro sensitivities. That's banks, that's insurance, that's energy, and that's airlines, which until a month ago, nobody wanted to touch. They are only just participating in the recovery rally. And from our perspective, that's where now the value lies.
What are the biggest macro risks for the equity market going into 2021?
We would say the biggest macro risk is a spike in bond yields, because the bond market has priced very little of the macro recovery. And we have seen in November how quickly these trades that haven't reacted yet, how quickly they can reprice the outlook. And so remember the taper tantrum of 2013, remember the Bund tantrum of 2015. The biggest risk for 2021, we believe, is not on the growth front, but rather the discount rate suddenly rising sharply and you having multiples being compressed by a sharp spike in discount rates.
That's fantastic. And that lets me turn now to Barnaby. Barnaby, in the fixed income space, just at the moment, we've seen a lot of bonds issued, but are issuance volumes where you might expect at this time of year?
Well, December is typically a very quiet month. And, we're a week into December and it looks like we've already had over 10 billion of issuance. So I think this will prove to be a much higher than normal December. But I think for the whole year, it's just been a phenomenal experience of companies being able to raise debt amid an enormous crisis. And that, for me, will be the legacy of this shock. Investment grade issuance this year should end around 600 billion. It's an enormous number for European credit, and it really reflects the depth of the market that we've seen. And, what drove us here, what got us here, it was the policy supernova, really, that we saw. The abundant intervention by the ECB, the pledging of more aggressive forms of quantitative easing. It just set the groundwork for liquidity to be raised by those who needed it the most.
Barnaby, how is capital being used by the firms who are raising all this debt?
What happened in March and April was the crisis hit. For the first time ever, economies were shut down en masse. And for companies, really, there was only one option, which was to raise oodles of liquidity just to show that you were able to weather this storm. We've been making the argument that corporates went too far. Mm-hmm. A simple metric to look at is cash divided by EBITDA. So how much cash does a company hold as a measure of its previous earnings? And looking at that over time, what you can see is in the aftermath of successive crises, companies in Europe have tended to generally increase their cash buffers. We know at Lehman time, part of the problem was that corporates went into that crisis without very much in the way of cash buffer. So in the aftermath of that crisis, they started to run with higher levels of cash to earnings. The sovereign crisis hit in 11-12, and then you saw the same kind of response. After this crisis, most companies in Europe most investment grade companies are sitting on cash in excess of a whole year's worth of earnings now, which I just think is too big. I don't think your classic company needs that much of a cash buffer. So next year will be very different. I do believe that you will see non-financials not issue as much, but I do think you will see a record year for tenders of debt at the front end of the curve, because the one way to use that excess cash efficiently is now to buy back your bonds.
Have the covenants been getting tougher? Because we have had some concerns around the covenants.
Well, for investment grade, it's never really a market of covenants. It's more a question of the quality of issuance that's coming. And, we're seeing more triple Bs, we're seeing more subordinated debt. A few months ago was a very big month for corporate hybrid issuance, which is subordinated corporate debt. So in that respect, the riskiness of issuance that's coming is growing. But that's something that the market is comfortable embracing. In high yield and in the leverage loan market, there's been an attempt to push back on very loose covenants. But again, we're in such a euphoric period for asset markets that cuff loose tends to win out. It's only in a bear market where the stringency of your covenants tends to pick up.
And how have the rates markets been impacting credit?
Well, it's all about financial repression. There's 64 trillion of debt out there in global bond markets, and only 28% of it yields above 1% today. It's a shocking number, and it's a terrible challenge for investors to find yield next year. So that's really your greatest tailwind for corporate bond investing in high yielding parts of the market, be it high yield, AT1, corporate hybrids, etc. So this environment of very repressed yields, this environment of central banks cutting rates below zero, has driven an enormous thirst for yield for corporate bonds in the last 4 to 5 years. And it's eventually starting to benefit markets like high yield, because it's really the only place you can go as an investor to get yields in excess of 1%.
That's great. Gentlemen, thank you very much.
Thanks.
Thank you.